All right, my name's Dan Bauer, and this is going to be my first YouTube video. I'm not a financial advisor, and this is not financial advice of any kind. And this channel is for informational, educational, and entertainment purposes only. And so, to start that off, basically what I'm making this channel on is essentially this. So, one thing I'm going to do is each week, me, my brother, we take $100 out of our paycheck and we put it towards this investment account. And then, and then I take, so I scrap usually on my way to work and from home from work. I'll go pick stuff up, free off of Facebook Marketplace, whatever it is. I'll scrap that shit. Hopefully, gonna do a few other things, and then I put that money into the account, and then I also if this YouTube channel ever makes any money, which it doesn't really matter for the most part. I'm not making this YouTube channel to make money, really. If that happens, it's great. If not, okay, whatever. Really, what I'm trying to do here is force myself to do better research, to work a little harder on that stuff, and to teach other people. And I think when you teach other people stuff, you learn more, right? I think that's just how that works. And so in that case, I'm going to, work to do my best research and put it on this channel. And I'm going to talk about everything I got going on, you know, uh, how I'm doing, what the positions look like, and all that, so forth, right? And right now, I started this account back in October, early October 2023. Right now, I got it up to $8,188.34. Well, we got it up to $8,188.34 because there's multiple. And my sister is also gonna do 100 every paycheck she gets. She doesn't get paid every week, and we're gonna build this together. And over the course, and it's gonna be like a 5 to 10 year time horizon, time span. And essentially, the idea is to take that money and invest it in the greatest companies we can. And then also, it's going to be built on, here's what I'm showing you. So you have the fear and greed index, and I'll pull up the timeline. Right now, we're in greed. We've been extreme greed for most of the last month and a half, right? Greed since late November. So about 2 months now, right? A little over 2 months now. And we've been around here, bouncing around and stuff. But generally speaking, is dollar cost average over time in the great companies. If they go up too much and they're really extended to the upside, and when things start getting expensive, things start getting expensive. And that's one of the things I'm going to teach on this channel is about how to kind of value a company and how to understand where we are in like a market cycle situation, short term and long term. I've been reading a lot of books on this stuff. Let me pull up. I'll search up the book. Well, first let me finish this real quick, and then I'll search up the book that I've just most recently read. And I'm gonna pull stuff from all these books, from famous investors, the greatest of all time. And I'm just gonna continue reading those books and learning more myself, doing more research and learning more about that stuff, kind of understanding everything in general. But really, I'm gonna talk about this specific. In both of these times, this is when SVB Bank failed, and FRC and Signature Bank New York, they all failed. And so everybody got super fearful in the market, and it got extreme fear levels, and the market dipped pretty hard, right? And because of this, that was an incredible buying opportunity. And if you were, in the right companies, pretty much the freaking best companies in the world, the top 25, top 50 stocks, there's probably, legitimately speaking, there's probably somewhere between 50 and 100 stocks. They're really actually investable companies. I'm looking for companies with very low to no debt on the balance sheet, high cash flow, like high free cash flow amounts, large net incomes, and a lot of cash on hand. These will solidify and make the company investable because in a bad market or a bad situation, they'll be able to live through it. And usually on the other end, these companies come out stronger and their stock prices go up. usually speaking. And when I say usually, pretty much all the time. If you think about it, if you look at Amazon or Apple or Microsoft from like before 2008, let's go all the way back to 2000. Amazon went up and it went down with the tech bubble crash. And so did Apple and so did Microsoft. And then they went up into 2008 and then they got smoked again. And that was pretty much the end of a credit cycle and also a real estate cycle at the same time simultaneously, and it all imploded, blah, blah, blah. You know what happened. They got smoked. Every company got smoked. But like if you had continued buying through that whole entire time and you didn't trip, what's it, 16 years later now? If you continued buying the whole time, all the way up, every time we had a fearful time in the market, like down here, and then you kind of laid back a little bit on your buying, maybe still bought a little bit, but of great companies, but said, I'm not going to buy so much in here. I'm going to wait for another one of these because these opportunities continue to come. There's no doubt about it. At the lowest point, right around here, I believe we got to a 17 one day because I paid heavily attention. I know at bottom, probably midday, it was 17 and it recovered a little bit into the end of the day. And I keep a good eye on this extreme fear stuff. And this was more like Israel and recession fears and how this and that the market's going to implode and there's going to be a blah, blah, blah. All the bullshit Wall Street tells you to fucking get you to sell on the ugly so they can buy up your shares. Let's be honest about that, right? They're always going to come up with some freaking reason to dip the market. And that's why you don't want to continue to buy super heavy. You want to still invest money into cash and then have an opportunity come or when the opportunity shows up and you're getting like fear in the market, when that opportunity shows up, that's when you got to be a player. That's when you got to come in and you got to buy heavy. You know what I mean? And so that's kind of what I'm doing. And I'm going to talk about some of the stuff in the next couple of videos I make. About this book. It's called Mastering the Market Cycle, and it's by Howard Marks. Here we go. You can pull it up right here. This book right here, you just buy it, right? And I might start, just throwing in links of these books in the description of my videos and when I talk about them. Because what I want to do, really a big thing is what I want to do is I want to take some of the best advice that's in these books, some of the best examples that is in the books, and maybe read a couple passages or do notes on a specific chapter and bring up the highlight points. Maybe I'll go through the books and highlight them as I go along and then come back and then be like, so this is, something I thought that would be very, very important on all of that. So let's go back to here and we'll just go to my stocks. So $8,188 in the count so far. It's going to keep going up every week because we're just going to keep adding to it. I want to really show the power of compounding interest and buying greatest companies and why I'm buying them. I'm going to bring up why I'm buying them and why I think, these companies are so great. Like Aristonet, I know it's like way up there. I know it. All right. Well, that's why I only bought one share, and not whole hog on it. But at the same time, I'm going to be realistic about this. At the same time, Aristonet is an incredible company. I mean, let's see if I can bring up some stuff about Aristonet. Let's see. Financials. Okay. All right. Let's go to their balance sheet. This is something I want to bring up about Aristonet. Look at that. This is one of the things I really want to look for. Total long-term debt, $0. They have no debt on the balance sheet. Now, let's go up here and let's look at their cash and cash equivalents. In the same quarter, they have 4.46 billion in cash and cash equivalents. So that's going to be short-term investments. So they have in cash and equivalents 1.75 billion, and in short-term investments 2.71 billion. And I'm going to teach you guys how to do this. So in current total assets, they got 7.65 billion. Now this company's still growing, and they're growing at an incredible clip, and they're still. I would say that they're not fairly valued, slightly undervalued at this point in time. But what happens if they do have a dip? And we have to understand that relative to what's going on with the company now, but not what the future growth is and what happens, 4 or 5 years down the road as they continue to acquire other companies and then build those out and scale them. I mean, obviously, this company has shown that they know how to run a freaking business. You know what I mean? You're looking at what's the total liabilities on this company. Your total liabilities is 2.56 billion. So we're going to look, so they got to pay 268 million. That's accounts payable. So they're going to have to, push those out. And accrued expenses, this is going to be like your employees and your CEO, probably stock-based compensation built into that. And so if we have total current assets at right about 3 times liabilities, we're looking at a company with an incredible balance sheet, especially when they don't have any debt. Total long-term debt, the total debt is 0 on this company. I mean, so we know that they have cash to invest in the business. We know that money's going back into the business. We know, and one of the things about it is something we have to understand is that companies that are still run by their founders tend to do way better than companies that aren't. You know what I mean? Essentially, I think because the CEO and the founder has a vision for this company and they'll do anything to carry it out. Whereas it's like a hired CEO, I'm just coming in to do the job. I'm going to try, I'm going to make shareholders happy, blah, blah, blah. But that's not what the founder's thinking. The founder's thinking, okay, shareholders are going to be happy, but I want to build my vision. You know what I mean? And so that's why I've got 4 companies here that are led by their founders. Palantir, which also, by the way, has no freaking debt and has $3 billion in freaking cash and short-term investments. So they have $1 billion in cash and cash equivalents and 2.24 billion in investments. And we're about to find out what they're going to grow even more. Their earnings call is Monday afternoon after the bell. So I'll get to see. I'm going to listen to their earnings call. I just want to teach other people, and it's going to force me to do more research and force me to be better. And while teaching other people, let's look at Tesla. So we'll compare this real quick. Hold up. So this company has in total assets $4 billion to total liabilities less than $1 billion. So we're looking like more than a 4x. That's a great freaking balance sheet with no freaking debt. You can give me a company that has net cash flows, is growing, or net profits is growing, has strong free cash flow, and is led by the founder, and has an incredible product with an incredible moat. Every day of the week, I'll buy that company's shares. Let's look at your total assets for Tesla, $106 billion. We're looking at cash and short-term investments, $29 billion. $16 billion in total cash in your short-term investments. I'm assuming that's all investments in the company, so they're investing back. Yes, the founder is Elon Musk, and if you don't like fucking Elon Musk, well, fuck off. I don't care what you think about him. So their total debt is only $5 billion. The liabilities are going to be higher for a company. Total liabilities are going to be, current liabilities is $28 billion. So, and your total current assets is $49 billion. So you're a little less than a double up on that. But we can't. You're factoring in as total liabilities like their facilities and all that good stuff. You know what I mean? So it skews it a little bit. But Tesla, with total debt at $5 billion, they can easily pay that off with their just cash and cash equivalents of $16 billion. Easily pay it off, no problemo. PayPal, another holding. Look at this, $56 billion in total current assets. Now they do have some debt, but they do have cash and cash equivalents. But and they do have a little more debt. They certainly have more debt than their cash on hand. But if we went to cash equivalents and short-term investments, they have more. So they can still pay that off. Now, I like PayPal just because of how cheap it's gotten. And the forward PE, so the forward price to earnings, so estimated earnings over the next 12 months versus the price of the stock, right? And I like PayPal because some of the things they're doing, and that they're, I think, a great deal. And then we have Meta. And Meta, well, I mean, they made $14 billion last quarter, just last quarter. Their balance sheet is incredible. Their total debt is $19 billion, right? But their cash and cash equivalents is $65 billion. And their cash equivalents or in short-term investments is $65 billion. And their cash and equivalents is $35 billion. So they can easily pay that debt off, right? But they're a cash flow freaking machine. And if you don't think so, just look at all the ads on Facebook. I know a lot of people who are going to watch this video are on Facebook. But basically what I want to do is make videos on research and everything and talk about the companies that I'm buying and why I would like to buy them and why I like to own them. Specifically debt-free companies, Aristonets and Palantir. Those probably should be the biggest two investments, to be honest. At any time Aristonet takes a dip, I'm going to be buying. But this video is kind of running long. I can just talk about this stuff, and that's why I'm making YouTube videos, part of that too, because I just like to do this stuff. And I would love to try to educate other people and do the best that I can and bring the most facts that I can to the table. If you like the video, I'd really appreciate a like, a subscribe. If you know anybody who might like this type of stuff, please share it to them. This is all going to be a long, long journey. So I'm just going to continue doing this stuff because this is something I really want to do. Thanks for giving me your time. Take it easy.